Hello, hello, and welcome everybody. I know you guys are just jumping in. Thank you so much for joining us. This is going to be a really fun webinar. It is going to be questions. You should see the chat box right there popping up on your screen. Send us a little chat. Make sure that you know it is working, that you know how to use it. We're going to be doing lots of Q&A, so I'm very excited. Today, we have Jake Alexander. He's going to be teaching us about how to minimize your tax liability, providing you timely and intelligent insight about all of your options, obligations, and assets. And their company, Hive, is really a cool company. I got to meet a bunch of your guys out in Provo, out in Utah. And we were talking about tax planning and services to small businesses, and you guys really love to focus on that. Just optimizing the taxes for real estate assets, creating those strategic plans for real estate operators and investors, and just optimizing those tax situations. So we thought, what an amazing opportunity to bring this to our students, to our clientele. So guys, write in the chat, ask those questions as they come up, but Jamie and I are going to be tag teaming it with Jake, just asking him all the questions we could think of before this call. So hopefully it's super informational to you, and don't hesitate to write in as we're moving along. So Jamie, do you want to kick it off with the first couple questions for Jake?
Yeah, of course. Okay, so the first one is just a simple one to start off. Who is Hive, and how did you partner with Kevin O'Leary?
Yeah, and we get that question a lot. So yeah, Hive is, we pride ourselves on helping business owners with proactive tax planning. And so, the concept of the company came from, we surveyed over 5,000 business owners all across the country, and it was just an overwhelming percentage of them felt like they didn't have a good relationship with their accountant. They felt like they were reactive instead of proactive, and there's just such a need in the industry for it. Small businesses, the backbone of the economy, in every country, and that's how Hive was born. So we really specialize in working with business owners and being proactive about helping them legally and morally pay the least amount of taxes as possible. And partnering with Kevin O'Leary, that's been a fun adventure for sure. And that's the guys back in Provo, Isabel, that you were talking about. They're the ones who put all that together. So I can tell you, his DNA runs through our company, and he's really big on just small business owners understanding, the tax code as much as possible, because it could just save you tens of thousands of dollars, over the countless years that you're going to run your business. And it's been a great adventure so far, and we're really excited to see what the future holds. So
I love that. How are you guys different than other tax groups? Because there's so many people to choose from. So why should someone choose to work with you guys?
Yeah, and we get that question a lot too. And it's with us, you get a tax plan when you sign up for us. So our actual service, it includes your in-depth, personalized, custom tax plan, which is literally like a 40 to 50 page document about your business or businesses and you individually. So all of our clients, we get copies of their past 2 years tax returns for all of their business and them individually. And then we have a questionnaire. And when I say this questionnaire is thorough, it's very in-depth, it's very thorough. Sometimes it's a little bit of a pain, to fill that stuff out, but the reason it's so in-depth and the reason we do that is because then we can really understand your situation at like a holistic level, and we can put this plan together for you. And so not only do we give you the plan, but then we can also help you implement it along the way and do all your filings, and really just work with you as like a partner with you in your business. So.
All right, awesome. Okay, the next one we have is, how do I qualify for a home office deduction?
Home office deduction. So the rules with that, you have to have a separate area exclusively used for business. So that's the big one. It can't be your guest bedroom that you have your friends come and spend the weekends and stuff like that in there. It can't be your laptop at your dining room table, that you eat dinner at, and then once the kids go to bed, you set up your office. It's got to be a separate area exclusively used for business. And once you've established that, and it's got to play a primary role in you producing income in your business as well, are the key components to qualifying. So.
I always try to get that deduction on mine. So is it better? This is always a question I have, because I do a lot of, I think I need to work with you guys personally, because I'm doing a lot of this stuff on my own. And here is a question, I think, for everyone who works from home. Is it better to take that actual deduction or the simplified square footage deduction?
Yeah, and so it all depends, right? Which is, I'm probably going to say that a lot. I promise I'm not trying to dodge your questions ever, but it depends. The simplified method with home office is, it's pretty simple. It's you get like $5 per square foot for up to 300 square feet, so it's like $1,500. It's nothing crazy. A majority of times, the actual method is going to be a much better way to go, because people don't understand that the home office is one that, it's not. It's more than likely never going to cut your tax bill in half, but it's every dollar matters at that point. So if you go with the actual method, what you do is you come up with a business use percentage. So we take the square footage of that separate room that you have divided by the square footage of your entire house, and you come up with a percentage. And it's generally between like 8 and 12% is pretty common for home office deduction. But then you could take that percentage of your mortgage interest, your taxes, if you own the property, that percentage of the rent, your utilities, like all sorts of things. Any furniture that you put in there can be a deduction. Any improvements you do to the property, like people don't realize if you put a new roof on the property, you can't just put a roof over the home office. You have to do the whole house. So you can start to just really get into some things that'll help you maximize,
I love that.
Yeah, that's good to know. Okay, the next one we have is, do I need to know about writing off? What do I need to know about writing off a car?
Vehicle. So that's a fun one. But very similar to the home office, you can do the simplified method or you can do the actual expenses method. And so for vehicles, the simple method is you get about 50 cents per mile. So the IRS loves to change it every year between like 52 cents and 55 cents for whatever reason, just to keep us on our toes. I tell people it's about 50 cents a mile that you can deduct. So if you had your home office, essentially all of your appointments leaving from your home office to go, visit your patients, or if you're in real estate, look at properties, all those sorts of things, whatever your business activity is, and you're going to add all those up, and you get 50 cents per mile at the end of the year. There's even some really good apps out there. One of them is called Mile IQ, so one I'm the most familiar with, that it runs in the background. And you literally just go and pick, like, it's like the dating apps, but for your mileage. It's like, was it business or was it personal, So, and then it gives you a really nice report at the end of the year that we can use that, or we could do the actual method, which a lot of times can be more advantageous just depending on the situation. But what we do there is similar to the home office, we come up with a business use percentage of the vehicle itself. And so everybody wants to say that their vehicle is used 100% for business. It's usually not. It's usually, if you use it a lot, it's 85, maybe 90% is where we tell people to max them out at. But if you do the actual method, you can do things like depreciation, which is really awesome because you can actually deduct the full price of the entire vehicle in the first year that you purchase it, depending on a couple of stipulations and things like that. So you can look at depreciation and then the actual any repairs you do or maintenance or those sort of things. And a lot of times that'll give you a bigger deduction, but it all just kind of depends on the situation. So
I know we had a question come in from Sarah about the home office, but I have to ask you this about the cars before we go. I've always been told to buy the big cars, right? I just bought like a Mercedes GLE and it's over 6,000 pounds. So what is the situation with that? You can write off more, or what's going on?
Yep, and so it's kind of what I was alluding to a second ago, but it's the Internal Revenue Code section 179 actually says if the vehicle you purchase is over 6,000 pounds, you can deduct the entire cost of the vehicle in the first year, even though you're still making payments on it. So these are the kind of things that, any time throughout the year you get it is great, but in the fourth quarter where we're really doing like strategic planning with our clients is, hey, I made, a ton of money this year. What can I do to minimize, my tax liability? Stuff like that is a great strategic purchase right there. So
awesome. Jamie, do you see the one question coming in? I see at least one. Are you seeing more than me?
No, I don't. I just see your
My one? Okay,
Yeah, I
I
didn't have a question, so
I
I think
see a question in from Sarah Jones, and it said, if you do a home office deduction, what are the ramifications if you sell the house? Are there depreciation clawbacks?
Ooh, that's a good question. There can be. If you take depreciation, it's real similar to, it's called recapture is what it's actually called. So it's very similar to depreciation on vehicles, like you were just talking about, Isabel.
Yeah.
With home offices though, the amounts that you're depreciating is typically not substantial where it's going to cause a major issue for you, compared to if you were to Section 179, the price of an entire vehicle. That's something you'd want to be conscious of. So to answer your question, yes, there is, but they're typically pretty small from a home office recapture standpoint. So great question.
Good question, Sarah Jones.
all right. Can the business cover and write off my health insurance? I am kind of curious about this one.
Yeah, absolutely. So the short answer is yes. The more complicated answer is like it can. It just depends on the structure of your company. So if you're a single member LLC, it's gonna be deducted one way. If you are taxed as an S corporation, it's gonna happen a different way. So it all just depends on the legal setup and kind of your tax situation on how we do it. But if you're a small business owner, you should absolutely be deducting your health insurance one way or another. Just like a few examples are, sometimes we do what's called an accountable plan where you reimburse yourself or the employees for the cost of the health insurance. Or you can do like an HSA, which is a health savings account, or even maybe a HRA, which is a health reimbursement account. Or once the company is kind of big enough or successful enough, you get just a company healthcare actual plan, and then it's all a deduction. So, but yeah, you should, if you own a business, you should absolutely be deducting the cost of your healthcare. It just depends on exactly how we're going to do that. So
That's awesome. So many of the people on our list got on our list because they're interested in residential assisted living, so senior housing. So is a business training like coming to our course, could that be a tax write-off?
absolutely. So it all there you go.
Hey.
It all depends though. So the answer would be yes. It just depends on how we're going to actually perform that. So continuing education in a business that you're already earning revenue is going to be all deductible in the first year. If this is for like a change in your professional environment, we may need to draw it out over a certain amount of years, but similar to the healthcare, one way or another, we're going to make that a deduction for you. Absolutely. So
Awesome.
Oh, great. So how does one correctly log the expenses, and what limits are those to writing off like training or stuff like that?
So tracking it, you just want to make sure that you have your invoice or whatever proof it is that you actually spent to sign up for the program. And then if it's in your current line of business, then it's 100% deductible in that first year. If it's for switching professions, then a lot of times it'll have to be amortized over a certain amount of time, which can depend based on your situation too. So.
We got a great question in from Jostine. He said, I got a K1 for my LLC in 2021 with a substantial loss. Can I defer the write-off for tax year 2022?
Possibly, but that would have to be done, I'm assuming, as a partnership that you're a part of. Some sort of investment is where you got the K1 from. So the fact that they did the tax return and sent you the K1 means the business is taking the loss in 21. So you would need to claim it in 21. But if it's not effective for you, you can do what's called a rollover to next year, but it all depends on a couple of different scenarios. So that answer would be possibly. So, but the short answer, yeah, if you put it in the tax return for 21, but it's not eligible because it's a different type of income or something like that, it should roll over for you to your 22 return. But stuff like that is where those are the kind of things where, and however anybody likes to do their stuff is up to them. But stuff like that. You don't want to do that on TurboTax yourself. Like you want to have a professional make sure it's categorized correctly, so you're not losing those losses or anything like that. You want to make sure it's booked as a rollover so you can take advantage of it when it makes the most sense.
Great. Looks like we have another question popping in. Oh, he just said, Jostine just said, thank you. Sounds like I need to call your office.
There you go. Exactly.
That's
But that's
great.
good.
What's the contact info so we can throw it in the chat just in case anyone wants it right now.
So we set up a page just for you guys. It's taxhive.com/RAL. If you go there, it's taxhive.com/RAL. You can book an appointment with one of our specialists, and we can do a deeper dive into whatever your personal situation is. So yeah, please go there, and we'd love to help you guys out as much as possible. So
Fabulous.
Yes, awesome. All right, so another question that we got is, who can use a qualified retirement plan?
Everybody. It's very similar to like health insurance. If you're a business owner, you should be writing off your health insurance. If you're a business owner, you should have a qualified retirement plan. And these are, to me, are amazing because it's, the government, the IRS is giving you a deduction on putting your own money away from retirement. So it's like, to me, it's the closest thing you can get to free money from the IRS. And there's several different ones. I kind of high level cover a couple of them. There's, a traditional IRA is you can put up to $6,000 per year into there. They're real easy to set up. If you're, we tell clients, if you're newer being self-employed or you just started your business, it's usually where you want to start. It's just a traditional IRA. You can put up $6,000 in there per year. It's a deduction from your income, so you don't have to pay taxes on it, and it's growing, tax deferred in whatever investments you put it in. Get a little more fancy. There's what's called a Sep Ira, which is a simplified employee pension IRA, where those you can put like over $50,000 per year in there. There's a little more requirements as far as like the owner has to pay themselves a certain amount of payroll and those sort of things, but it's a fantastic tool. If you get to a point where you're making good money in your business, you absolutely want to do stuff like that. There's another one called a solo 401k plan that with that one you can put over 50,000 in it too, but you can actually include your spouse. So if it's you and your husband or wife or your spouse working together in the business, you can actually both contribute to those and put away like over 6 figures into a retirement account. So yeah, everybody should have one. Those are a very big part of our planning process too, that we go through with our clients, and we're typically always recommending something like that for them. So
can you put in alternative investments like crypto and gold and stuff like that into those?
Yeah, well, so yes, essentially it all depends on who houses the account for you. So you want to get with a provider that allows you to invest in alternative investments. But yeah, people buy properties with them. People buy crypto, gold, all kinds of different stuff, stocks. It's essentially your individual retirement account that you're self-managing. So yeah, you can, I don't want to say invested in whatever you want. We try to stay away from that term. But yeah, you can get creative and do all kinds of cool stuff in there. So
that's awesome.
Yeah, speaking of properties, so if you want to like rent a property, how do you incorporate that, like about when the property depreciates? Is there a downside to that? Like what are the things that we need to be aware of if we're owning like a rental property?
So if you owned a rental property in there, it would be very similar to owning it in your personal name. It's just all of the income that it was generating would go back into the plan. It wouldn't go to you personally. And so the depreciation, the deductions, all that kind of stuff would be very similar. It would just be a difference of who owns the account. Technically, the retirement plan does. So if you're going to do that, you want to make sure that you're not planning on accessing those funds like anytime in the immediate future, because there's penalties and those sort of things.
So if you were to sell the rental, does that reduce the tax liability? How does that work?
If it was in an IRA and you sold it, it wouldn't necessarily save you on, because the way it works in an IRA, when you sell something in there, the gain that you have on it stays in the account. And so you're not
Yeah.
paying any taxes on there until you start withdrawing it when you're at retirement age. So in the short term, you wouldn't pay any taxes until you start to withdraw the actual money out of there. For a lot of people, that's the well, what's the word I'm looking for? Like the benefit or the draw to an IRA is you're building all this money tax deferred. So you're either, you know, making money in the stock market or whatever your alternative investments are, and you're just building up this nest egg that you're not going to start essentially pulling from until a much later age. So.
Can you use the home sale to avoid paying taxes? Like, you know, people will say for the 5 years you live in it for some and then it's a rental for others.
So that applies more to your personal residence, not a rental property. So I wouldn't put those in the same bucket. So
Okay.
good.
So
I like where your head's at though. You're getting creative, you know?
so I guess what are the benefits to purchasing a property and leasing it to your business?
Yeah, so you could purchase your property and lease it to your business. If this is a commercial building, then you absolutely want to do that. The way you essentially do it is you buy it under one entity, and then that one leases it to the other one. So there's a couple strategic reasons people do that is, you know, that whatever the business is that you're operating has run out of that location for however many number of years. If you ever were to go to sell the business, you could sell the business, but then still maintain the real estate that the business pays rent to every month. So that's a great strategy to build wealth long term. For like a home office, you really wouldn't want to get into something like that. It's almost kind of more complicated than it's worth. We would just take the home office deduction. But a really cool thing you can do, which is nicknamed the Augusta Rule, which is Internal Revenue Code Section 280A, says that your business can rent your personal residence from you for up to 14 days per year. Has to be for a specific business purpose, and it has to be in line with, you know, going market rates for a similar venue. But you can do things like host, you know, if you have board meetings and you need to have them once a quarter, if you want to have a networking event, you know, where you invite all your customers or employees or things like that. So that can be a great way to cash in on a little deduction right there too. So
With that question, and I'm thinking in the residential assisted living world, a lot of people will purchase the business, you know, and rent it, or purchase the real estate and rent it to their business. So in that case, you recommend that or think that that's okay?
absolutely, yeah. So when you do that, yeah, it sets you up really good down the road. There's a couple requirements, like it incurs sales tax. When you do that, one entity has to pay sales tax to the other one. But to me, that's well justified in the long-term plan there. So
Awesome.
Okay.
especially with those buildings, because they're going to be of a higher value, I would assume too. It's not a smaller 2-bedroom house. Those are probably bigger units. So yeah, absolutely.
Yeah.
Yeah. And then with that, if you want to, you know, if you're doing like a family business or you're working with your spouse or kids, are there tax benefits to hiring them on to help out with the business or stuff like that?
Absolutely. So you hire your children. That is a great one right there that a lot of people are unaware of. A lot of people don't realize you can hire your children to work in your own business. Now they have to perform an actual role in the business. You can't just make this up, right? And you have to pay them in line with what you would pay somebody else to do similar activity, you know? So if you do, you can actually pay your children a little over $12,000 per year. And if that's their only income, then that money is a deduction from the business and it's tax-free to the children. And where we've seen that stuff get really interesting before is you could invest that money, you could do whatever you want with it. You could give it to them and let them go buy Legos or whatever, or you could, you know, you could put that money in a retirement account for them. You could actually put it in like a Roth IRA that is a post-tax investment. And, you know, we've seen clients do that for a number of years. That money will compound and sometimes be enough to like fund a whole college account, those sort of things. So yeah, that's definitely a good one. So
I love that. Is there a best type of entity to have?
no, it depends on that. The most common and the simplest one is an LLC. They're the most commonly known. You know, you can go online and set them up pretty quick in all 50 states. It's not necessarily the best for everyone because it all depends on your situation. So if there's more than one person in your company and you go and set up an LLC that has two owners, the IRS automatically wants to tax that as a partnership, which is a different tax form than just a single member LLC. So you really want to consult with a professional before you just go setting stuff up, because you don't want to get in a situation where the IRS is expecting a partnership tax return every year, and you go 2 or 3 years and never file one. The penalties can be ridiculously high on stuff like that. So a lot of people ask about an S corporation, which is great to be taxed as once your net revenue reaches over a certain number, but until then it's really not necessary in my opinion. So
Okay, so with the S Corp, since you mentioned it, when does it make sense to file as an S Corp?
So once your net revenue, so over about that 30,000 per year mark, that's when it makes sense. And if once it gets over there and you plan on it staying there for several years, that's when we tell people it really makes sense. So
are there things that we need to be aware of when you are doing that S Corp election?
yes. So the easiest way I explain it to people is when the benefit of being taxed as an S corporation is it's going to save you greatly on the self-employment tax portion. The requirement is there's two main ones, but you have to file 2 tax filings now. So you actually file a business tax return and a personal tax return, and then the owner needs to put themselves on payroll. So that's why we say that 30,000 mark is where there are some additional costs in consideration with doing that. So once you get over that 30,000 mark is really where the excess cost and the tax savings are more of a break even,
All right, so I know you kind of mentioned we're talking about alternative assets like crypto and rentals and all that, but if you want to invest in crypto, how is it taxed?
It's taxed very similar to stocks. So it's capital gains. So the way the government looks at it is you're buying something and either making money or losing money on it. So it's taxed at capital gains. There's 2 ways that can work. It's short-term capital gains or long-term capital gains. If you can, you always want to push to long-term because 9 times out of 10 that's going to be a better rate, a lower tax rate that you're actually taxed on. Realistically, with the crypto stuff, I think that's virtually unheard of. Everyone's buying it, selling it on a daily basis or weekly basis, which is fine. It's the easiest way to explain is it's taxed very similar to the way stocks are. So.
Okay. And then with that, is there a difference between mining and buying and selling crypto?
Yeah, there is.
Okay.
Yeah, absolutely. So buying and selling it is capital gains. So you're essentially buying an asset, you're making money on it. When you sell it, you pay taxes on the difference. So that's either taxed at long-term capital gains or short-term capital gains based on how long you had it. Mining Bitcoin is an actual business. So that's considered business income, which would be very similar to, I don't say any other business owner, but other business owners in the, IT space or technology space where basically all the money they bring in from the business is their revenue. All of their expenses they can deduct from there. So all the computers they have to buy, I think they need a ton of them to do that stuff. Whatever space they have to house them in, whatever their electric bill, all of that stuff are deductions, and they pay taxes on what's left basically. So
that's really interesting. Michael asked a question and I'm not sure you will be able to answer it or any of us will, but he said, where can I find an established business to purchase that provides immediate positive cash flow?
I like this guy. Yeah, I mean, that's not really all. I would love to buy some of those too. So when you find them, you let me know. There's a ton of websites out there, like BizBuy. I mean, and I don't know if you guys want to get into this, but I'm not an expert in that. But there's like Biz Buy Sell, Franchise Gator is one. There's a whole market for that kind of stuff. So
Yeah, Michael, if you're
but
looking to do residential assisted living and looking to buy one of those that's cash flowing, come to our training because we teach you what to look for and what to avoid. That will be helpful. And then Jake and his team can help you work out all the taxes on it.
absolutely, and that's what I was gonna say. If you're gonna buy a business, you don't want to do it before you discuss it with an accountant, because there's different ways you can structure the contract where it can be very beneficial for you in the next few years after you purchase it. So yeah.
Awesome. Because a lot of people on our list deal in real estate, right? Maybe not just residential assisted living, but other forms of real estate. Is there something that they should be aware of, or some tips or some just info on flipping homes and reducing liability? Is there anything that they can look out for in regards to that?
Yeah, and so flipping homes is becoming, or has become more and more popular in the past few years, obviously, right? So the biggest one, although it sounds really simple, where we see people just kind of leaving money on the table, is just not keeping good documentation of all the money they put into these properties. So if you're gonna flip properties, have a separate bank account that you're gonna run everything through. Even if you don't have a business set up, it could be a separate personal checking account, but don't commingle the expenses with your personal bank account. We see that all the time, and people are like, well, we give them their tax return, like, I didn't make that much money on the property. I'm like, well, that's what you gave us, was you bought it for this much and you sold it for this much. Like, no, I put $30,000 into it. It's like, you need to have that stuff very clearly defined, because those $600 trips to Home Depot, and I paid that contractor $1,000 to do whatever. People tend to forget about that stuff when it comes time to file the taxes. You want it to be really clear and come out all out of one account, so that way you're paying taxes on the least amount as possible. And then, once again, it's the short-term, long-term capital gains. So if you can keep it for over a year, that always helps. And then kind of, you brought it up earlier, there's ways you can kind of, I don't want to say, you can use the time frames of different codes in the section where you could buy a house, fix it up, live in it for 2 years, and then not pay taxes on any of the gains. So there's some real creative things you can get into kind of the more you get into that world. So
yeah.
Awesome. Okay, next one is, can I write off meals and entertainment?
Yeah, absolutely. And then you can, as long as they're for a specific business purpose and include a business cohort, we like to call them. So the IRS actually changed it where to the end of, I know it's to the end of this year, it might even be to the end of next year. I have to double check. The meals are 100% tax deductible, actually. So that was one of the things the IRS did to help stimulate the economy with the whole, shutdowns and all that stuff. They wanted to encourage business owners to go out to restaurants. So meals and entertainment are 100% tax deduction, absolutely. As long as it's for a business purpose and you have a business colleague with you. So
that's awesome. What's like bookkeeping or organizational advice or tip that helps during tax time?
The best advice is to not worry about it at tax time, because you've had a good bookkeeper all year before, and then that way at tax time we're just pulling reports and getting what you need. It's really kind of back to the organization thing, is if everyone's business is different, right, and everyone's resources are different. In the beginning, when things are tighter, a lot of people are doing that stuff on their own with an Excel spreadsheet or the actual bank accounts, highlighting one thing yellow, one thing green, that sort of stuff. But as your business grows, you want to have a professional bookkeeper, because you more than likely it's not your skill set, so you don't want to take time away from your business to do it on your own. And then B, you might be missing stuff, and then when it does come tax time, you don't want to have to spend 10, 12, 15 hours going back and forth with somebody to categorize all this stuff, when you could do it just all throughout the year. You know, have it done on a monthly basis by a professional, and that way there's no questions or any of that kind of stuff. So
I love it.
Okay, I know you mentioned the Augusta Rule earlier, but do you want to tell us a little bit more about it or what it is? Because I know you mentioned it earlier, but I didn't know if you specifically told us what it is.
Yeah, so the Augusta Rule, the IRS says you can rent out your personal residence for up to 14 days per year, and the revenue generated from there is tax-free. So if you own your home, and this is for people, you know, where the nickname comes from is from the fancy golf tournament every year at Augusta National Golf Course. The people who live right on the course could rent their homes out for like tens of thousands of dollars per night. And so they actually, it's pretty crazy. Yeah. So and this is the story. I've never verified this, but the fable is back in the 70s, the people of Augusta actually went to the IRS and lobbied for, you know, this code section to get passed, and it did. And so that's why they nickname it the Augusta Rule. So for people who, you know, live in more of like a vacation type place, you can literally just rent your house out for, you know, whatever the going market rate is. Or if you're a business owner, your business can rent it from you for specific business purposes. And that's kind of what I was talking about earlier, like, you know, board meetings, networking meetings, you know, sales events, those sorts of things.
Yeah.
You just want to always make sure you have really good documentation with that. So
That's awesome. Lan Lu, I remember you, Lan Lu. Hi, she just wrote in a question and she said, if I have multiple rentals, do you suggest each one to be in their own LLC with their own bank account? She said, I have 10 rentals and it can get to be too many bank accounts.
Oh, Ted, yes, I would, although it's a little bit more work. It's worth it. Unless you're just really good at organizing it, I would recommend having them different. So, you know, I'm an accountant, I'm not a lawyer, but a lawyer would tell you want to have every property in a different LLC. So like if something happens in one of them, somebody couldn't try to sue you, you know, and get access to all of them. And then for the expenses, it's probably a little bit of a pain having a separate bank account for all of them. But yeah, I would absolutely do that if you can endure it. And then, you know, if you're tracking the stuff yourself, that would be great. But that's a perfect time to hire a bookkeeper too. You know, for a couple $100 a month, they could go through all that stuff. They would reconcile it. They would send you a report, and you could go, you know, back to the beach and enjoy your beverage or whatever it is that you're doing. You know.
I love it.
Yeah.
And it would be a tax deduction too to pay for that professional service. So
Yeah.
Awesome.
What is QBI and who qualifies for it?
QBI is qualified business income. This is one of the updates when they did the Tax Cuts and Jobs Act back in 2018. It's really awesome, actually. So if you have a business that operates as a pass-through entity, which means the income from that business shows up on your personal tax return, which a majority of them do, you actually can qualify for up to 20% deduction right off the top of the revenue. So it's basically like 20% less that you have to pay taxes on. So this can apply to people with rental properties, people with businesses, whether they're taxed as an LLC or as an S corporation, sometimes a partnership. It's a pretty broad thing, but it's an awesome deduction if you do qualify for it. So
That's great.
Okay, so you kind of mentioned like planning earlier, and why does planning matter?
Planning matters because there's only so much we can do like now for clients that we're doing their 21 tax return. You know, we're good and we're creative, and obviously if there's, you know, things you haven't thought about or stuff that we can still do, we're going to bring those up to you. But it's really about being proactive. Like a good tax planner, somebody who's going to work for you or work with you on this stuff, is going to give you advice moving forward, because generally people are planning to make more money as they go along, right? Especially if you just started your business. And like, what's the long-term plan? What are we really trying to accomplish? And that's why just, you know, planning is essential. In my opinion, it's all about being proactive instead of reactive. And then this stuff is only going to just have a compound effect over the years and help you more and more. So.
Yeah.
I love that. This has been awesome and very, very, very informational. I know we asked you earlier, but how can everyone on this webinar get in touch with you and your team if they want to learn more and work with you guys going forward?
Yeah, absolutely. You go to taxhive.com/RAL, which we set that up specifically for you guys. You can book a consultation with one of our account executives. And yeah, we'd love to, if you got questions, we'd love to dive into those, tell you a little bit about how our program works, and just, yeah, if we can help. I love this kind of stuff, especially the Q&A. It's like, man, I don't have to make a presentation. I don't have to worry about everyone falling asleep. It's like, so to me, this stuff is fun, you know?
This has been great. I really appreciate it. Well, guys, if you have any last questions, submit them now. If not, click that link and schedule some time with Jake and his team. As you can see, he's full of information and they are so happy to help you on any of your tax questions, whether it's your other businesses, your assisted living business, or just you as a person, as a human who needs help with this as a small business owner. So be sure to click that link. We put it in the chat one more time. And for everyone who missed this webinar, we will send out the replay, or if you want to re-listen to all of Jake's incredible answers, we will send it to you too. But any last parting words?
No, I'm good. Great questions. I love being a part of this. Thank you guys so much for your time. If we can help in the future, we would love to be a resource. So yeah, thanks for having me.
Awesome. Thank you so much. Thanks, everybody.
Thanks, everyone.
See you guys. Have a good one.
Bye.